What if I told you that silver could shock the entire market in the next few weeks? Not with a breakout, but with a sudden drop below $50. Most investors are watching gold. Most headlines are chasing inflation. But quietly, silver is sitting at a crossroads. And today, we are going to look at the real data. Not hype, not fear, not clickbait. If you care about protecting your money, this is important. Before we go deeper, take 2 seconds right now and tap like, and make sure you're subscribed to Safe Haven Wealth. It truly helps the channel grow, and it tells YouTube you want more real, data-driven market updates without drama. Now, let's get into what's really happening. Silver has always been the more emotional cousin of gold. It moves faster, it spikes harder, and when it drops, it can feel brutal. The big question right now is simple. Is silver about to crash below $50, or is this just another shakeout before a larger move higher? Let's start with something most people ignore: positioning data. Large institutional traders, also known as commercial hedgers, have been slowly reducing their aggressive bullish exposure. That does not automatically mean a crash is coming, but historically, when commercial traders get cautious while retail traders are extremely excited, volatility increases. Silver tends to punish crowded trades. At the same time, industrial demand remains strong. Silver is not just a precious metal. It is heavily used in solar panels, electric vehicles, electronics, and medical equipment. Green energy policies in the United States continue to support long-term demand. That creates a strong fundamental floor under prices. But here's the catch. Fundamentals do not control short-term price action. Liquidity does. When the US dollar strengthens, silver often struggles. Recently, the dollar index has shown resilience. Bond yields have been volatile, and whenever yields spike unexpectedly, metals usually feel pressure. It becomes more attractive to hold yield-bearing assets instead of non-yielding metals like silver. Another factor investors should not ignore is margin pressure. When markets get tight, funds sometimes sell winning positions to cover losses elsewhere. Silver, because of its liquidity, can become a source of quick cash. That kind of selling can trigger sharp emotional drops, even if the long-term story remains intact. Now, let's talk about technical levels in a simple way. Markets remember numbers. $50 is not just a price, it is psychological. If silver approaches that level from above and fails to hold it, fear could accelerate. Stop losses could trigger. Short-term traders could flip bearish, and that could create a fast move lower. But here's the other side. If silver dips near 50 and buyers step in aggressively, that could confirm strong support. False breakdowns are common in precious metals. Big players sometimes push prices below key levels just to shake out weak hands before reversing upward. So, what does the data actually say right now? Volatility is rising, but not exploding. Open interest has not shown extreme panic. ETF flows have slowed, but not collapsed. That suggests caution, not chaos. Another overlooked indicator is mining stock performance. Historically, when silver is about to crash, mining stocks tend to underperform first. Right now, mining equities are showing mixed signals, not full breakdown behavior that weakens the immediate crash argument. However, we cannot ignore macro risk. If the Federal Reserve signals tighter policy for longer, or if inflation cools faster than expected, metals could face temporary headwinds. Markets price expectations quickly. Even rumors can move silver sharply. Let's step back for a moment and think strategically. Are we investing for the next week or the next 5 years? Short-term traders care deeply about whether silver drops $5 or $10. Long-term wealth builders focus on structural demand, currency debasement, and global debt levels. The United States continues to run significant deficits. Global central banks have increased gold purchases dramatically in recent years. While silver does not receive the same official buying attention as gold, it often benefits from the same fear cycles. There is also something called the gold-to-silver ratio. When that ratio becomes stretched, it often signals relative opportunity. Recently, the ratio has moved but not reached extreme historical panic levels. That suggests silver is not in a full-blown bubble, nor in a full collapse. Now, let me tell you something important. Markets rarely move in straight lines. If silver were truly about to crash below 50 in a dramatic way, we would likely see clear warning signs, heavy ETF outflows, aggressive commercial short positions, collapsing mining stocks, and a surging dollar all at once. So far, we see caution but not full alignment for a major breakdown. That does not mean downside is impossible. It simply means probability matters. Risk management matters more. Imagine this scenario. Silver dips below 50 briefly due to algorithmic selling. Social media explodes with panic. Retail traders rush to sell, but institutional buyers quietly absorb supply. Within days, price stabilizes and rebounds. That kind of move has happened before in commodity markets. On the other hand, if economic growth slows sharply and industrial demand expectations drop, silver could see deeper pressure. Remember, unlike gold, silver has a heavy industrial component that makes it sensitive to recession fears. So what should you watch over the next few weeks? Watch the US dollar trend. Watch bond yields. Watch ETF flows. Watch how silver behaves at key support levels. Does it bounce quickly, or does it struggle and grind lower with increasing volume? And most importantly, avoid emotional decisions. Markets are designed to trigger fear and greed. Smart investors plan ahead instead of reacting to headlines. Here at Safe Haven Wealth, our goal is not to predict every tick. It is to analyze probability and protect capital. Right now, the real data suggests elevated volatility, but not confirmed collapse. That means caution, position sizing, and patience. If you are a long-term believer in precious metals, short-term dips can become opportunities. If you are a trader, clear invalidation levels are critical. Never risk more than you can afford to lose. Let's also talk psychology. When everyone expects a crash, sometimes the market refuses to give it. When everyone expects a breakout, sometimes the market pulls back. The crowd is often early. Not wrong, but early can still be expensive. Silver has a history of explosive rallies after long consolidations. It also has a history of sharp corrections that scare out weak holders. The key difference between panic and opportunity is preparation. Right now, the data does not scream immediate collapse. It whispers, "Stay alert." That is a big difference. If silver breaks and holds below 50 with strong selling volume and weak rebounds, then the bearish case strengthens. But if buyers defend the level aggressively, we could see a powerful reversal that traps short sellers. Remember, markets transfer money from the impatient to the patient. As we move forward, keep your focus on structure, not noise. Short-term headlines will always exist. Real wealth is built by understanding cycles. If you found this breakdown helpful, I want you to comment below with one word: bullish or bearish. I read your comments personally, and it helps us understand what our community is thinking. Also, share this video with someone who is watching silver closely right now. Conversations create clarity. And if you haven't already, make sure you're subscribed to Safe Haven Wealth so you don't miss the next update. The next few weeks could be critical for metals. Silver is at a decision point. Not guaranteed to crash, not guaranteed to explode, but positioned for movement. The real winners will not be those who panic. They will be those who prepare. Stay calm, stay informed, and I'll see you in the next one.